we've raised nearly 500 crores and that seems a heavy upfront investment.
See, you can have a bootstrap company. I mean, the thing is, it takes like 25, 30 years to do that. We're just trying to compact that to 10 years.
Bombay versus Bangalore, different bubbles and different DNA.
How do you decide what's the right valuation? How does a founder engage with you on those discussions?
So the question is, can you actually imagine a future business model? And therefore that valuation of that future company, let's just say is $100 million. Today, at what price do I want to enter?
It's been rumored that VCs get paid really well. It'll be great to know how you personally invest. Hi, I'm Sandeep. At the Create Wealth podcast today, I have with me Saravanan, who is leading financial services investing at Premji Invest. Vikram, who is managing director at what is now called Z47. Back when they invested in us, it was called Matrix Partners. Mridul, who leads Fintech at Elevation. And Abhinav, who is an investor from Accel. So initially when the team had suggested this roundtable, as they were calling it, I was sort of gotten a little excited about it for two reasons. One is obviously that this is the first time I'm seeing a board come together on a podcast. The second is that this time I get to ask you guys questions.
I knew that was coming.
So what I wanted to start with is how all of us coming together actually happened, right? Mridul, you and Vikram led our seed round way back in 2021. What's your backstory?
I think we got introduced by my good friend Anshu. For us, we'd been, looking at someone in the wealth space for a long, long time. I mean, we love capital markets businesses. And I remember we met on 26 Jan 21.
Yeah.
Like we called you on Republic Day to our office, opened the office middle of COVID. And I think we spent like half a day or a day together. And it was very, very clear by the end of the day. I think we showed our eagerness also then. I also keep telling team this or keep using this framework of, Bombay versus Bangalore, sort of different bubbles and different DNAs. And for some reason, I felt like wealth space needs a more Bombay focused team with the condition that Sandeep moves to Bangalore over time and absorbs that DNA. So that's finally happened, by the way. That's a CS that took 2 years.
3 years.
3 years. I mean, for a seed check, it was quite an obvious one for us.
And for me, it was one of the easiest decisions to make. One, we've just known each other like more than a decade and gone through lots of these different life changes together. And from that time, I knew at some point of time you were going to start up, and I had pretty much said that we would want to do something with you guys. But on wealth tech, actually, we had a negative thesis for a while. We didn't think that wealth tech was a pull product. We like investing in pull product, and we thought it was a push product. And thankfully, just about the time that you were starting up, our view had changed. That now wealth tech has become much more pull than push. So the thesis became very easy. And then knowing you, knowing Vaibhav, knowing Sahil, that just made it very easy.
Abhinav, we connected in 2022, and you asked me almost in the first meeting that how soon are you trying to close this? And I said that in about 4 weeks' time we should be done and dusted. And you said, yeah, we'll be ready by then. Like, would love to know about what went behind the scenes at that time.
Yeah, so I think we knew about Dezerv from various places, obviously from the circles, some founders we invested in. And I think in the first meeting, it was pretty clear that, somebody one would want to work with, and the team that has the background to build a business in this space. So that really wasn't really a question as such. On the wealth itself and sort of the market, I think we were always sold on this discretionary side that, as India grows, there is wealth in the country which is going to grow. And there is clearly this theme of financialization of assets. And people, as they go richer, they'll need somebody to manage their assets instead of doing it themselves. So that's like a pretty compelling reason to do it.
Saravanan, I was telling Abhinav that it took us 4 weeks. We interacted for 8 quarters before Premji came in, and part of the reason was obviously the fact that we had just raised from Accel, and the Accel-led round in Series A.
I remember our first meeting. In that meeting, Sandeep knowingly, he kind of like knew that the round is going to close, and he very openly told that, I'm just kind of like in the middle of closing a round. We have been heavily indexed on lending for quite some time. India as a market segment was evolving from credit hungry to a surplus financialization, and a new generation of mass affluence were kind of like getting created. It's a question of not if but when this will kind of like happen. And just post COVID, we are kind of like revisiting all our thesis, like what we should do. Wealth was clearly showing right signals. Now, when you are kind of like thinking of further scale, we thought that's the right stage where we can come in and add a little way of capital plus other values. Hope we kind of like are still adding in that process, right? So that's our experience.
When you see a company at different stages, how do you decide what's the right valuation? How does a founder engage with you on those discussions? And I don't think enough investors also talk about it.
For us who are coming in very early, you don't have E, so you can't do
E is earnings. You don't have any revenue.
You don't have any. Sometimes you don't have revenue, leave alone profit. So the question is, can you actually imagine a future business model? And so a lot of that is the conversation between the founder and you to say this is what the future looks like, and therefore in the future this is how this company business model is, and therefore we have some comparables in the market, and therefore that valuation of that future company is X. And then it's a function of, if that future company valuation, and for let's just say is $100 million, today at what price do I want to enter? Do I want to enter at 20? Do I want to enter at 30? That conversation is much more art than science, and great founders like you will have multiple people who want to bid at a price, and then the price goes up at that entry.
That's not actually how it happened, but we'll leave that for a drink.
See, I think the more liquid the asset, the more efficient is the price discovery, right? As we all know. The more earlier you get, the more hazy it is. So I firmly believe there are comps and projections you can do. There is always a range. I believe there is a range below which a founder will walk away, and there's a range above which an investor will walk away. Now, the art of negotiation is where do you land in that range. In the end, market clearing price wins. And the irony is that the more early stage the business is, in the venture business, we do seed and A, actually acts of omission hurt you most. Acts of omission means the investments you missed on, because the upside is unlimited and the downside is capped, right, to the small check. Therefore, over time, I've come to believe you really have to build conviction early stage. You want to do something or not, and then let the clearing price decide what it decides. Of course, ownerships are important, valuations are important. You do that, but you play to a certain level. You can't over optimize. But the later you get, which is your check size is increasing, the business is more predictable, especially in public markets. Acts of commission hurt you the most, because the downside on losing a large check and that filling that hole is very hard. Which is why, if fundamentally, when you see the investors who are late stage versus early stage are very different in the way they think. And I very rarely do I know investors who can straddle both, because it's a very big mindset shift. In one side, you are protecting capital while optimizing for upside. In one side, you are saying, look, I can't miss something because the upside is uncapped. And that, I think, reflects in how pricing gets done, at least in my
You need
view.
a very different mindset for both stages. It's very difficult to straddle. For example, if you are kind of like taking a deal at a Series B or a Series C stage, right? So I think it's a combination of 2-3 factors. So one is what is kind of like already there, right? And then like every business models, the outcomes necessarily do not kind of like live up to the plan that we signed at the time of an IC. There will be like always deviation, overperformance in some situations, underperformance in some situations. So there you will kind of like build in some sort of an optionality, right? There will be 2-3 variables that will come up. So once you kind of like identify those variables, you price certain optionality. But again, it's not a clear science, right? So it's a little bit of a art comes in. Probably that art entirely translates into science near to an IPO, right? That is the only time where it will be like super metric driven, like this is your PAT, this is your price earning, this is a comp. That's where it stops, right?
Saravanan, you've invested across stages. I know that Abhinav, Mridul and Vikram typically prefer to come in earlier and they back their winners over a period of time. But you've invested over different stages of the company. How does what you evaluate for in the company change over the course of the journey?
when we are kind of like coming at an early stage, it all boils down to people in the team who are kind of like building this and what their intents are and what kind of like they are set out to kind of like build in the long term. And of course, people who have kind of like placed a trust early in their ecosystem kind of like matters a lot also, right? That shows a very strong sense of credibility, right? But when you talk
so in the
journey,
early stage, you're saying it's more about the team,
it's more
or
about
the
team, some sort of a product
complementarity?
market fit, and how it is kind of like aligning with a thesis for the sector, right? So that's what we kind of like fundamentally look at when you come in at an early stage. At a growth stage, we kind of like start looking at how those thesis translates into numbers and early signs of growth. In our case, how much the retention happening and some of those things will kind of like play a role. So we have to switch gear fast to kind of like be part of the journey across these stages, right? So that's how I would kind of like as a fund we look at.
There's a joke one founder told me long back, which comes to mind. So this is very lending specific. So he said in early stages, it's priced to bhook. So it's priced to hunger because there's no book. There's no lending book. And then as you grow, it's priced to book because then numbers really talk. So it's priced to book to price to book, potential to performance.
But even at like between, let's say, a mid-stage company to a later stage, right? So let's say between Series B, C to pre-IPO, even there'll be different metrics that you probably are looking for, right?
I think that, like Saravanan said, early on, you're looking at team, then you're looking at sort of early PMF, which is signals that say that there is PMF, which is you found a set of users, those users really love you and they're willing to give you money. And then you're looking at sort of scalable, repeatable PMF. By this time, we are at the Series B, Series C stage. Is it that you can find the set of users and actually scalably, repeatably continue to serve these users and make money?
Let's talk a little bit about the investment thesis itself, because for a lot of people, I think it'll be easier to understand and relate with what's the process that goes behind deciding to make an investment in a company. At the very top, there is Fintech, which is got payments, lending, insurance, and then wealth management. And within wealth management also, there are transactional players, which are like brokerages, which have scaled very rapidly. But there hasn't been a very large-scaled managed assets player yet. Besides the macro, what are some of the things that companies in this particular category you thought should be looking at?
I would say, I think the first thing is that the realization that wealth and managed assets is truly wealth versus the transaction platforms, and wealth is just a long game for everyone. It's a long game for as a retail investor if you want to accumulate wealth. And as a company, if you're essentially in the wealth business, your AUM builds over a period of time and then your revenue lags. And therefore, that business model is actually a very tough business model. And before I used to think...
Vikram, just explain that because for most of us, it will be very hard to understand what do you mean by revenue lagging. Like, if you can just explain that, it'll be nice.
So actually, let me give you a very simpler analogy. And so if you look at investing in semiconductors, and I'm going to go very right field here, you actually have to do a lot of research for a long period of time. And so therefore, venture capital actually fills that void. You can actually do that period of research, and then suddenly the product comes and it sort of takes off. And therefore, actually, venture is actually a good model even for wealth, because for some period of time, you're actually just building products, and then you're actually getting to a set of users, and those users are giving you some money. And then they accumulate that money over a long period of time. And initially, the assets that you, or the products that you market, are not necessarily as revenue generating as when you built that trust and you are managing a much larger amount of money. So you acquire users, give them product one, then they start growing with you, then they become wealthy, and then they give you more money, and then those assets really start generating and compounding, right, with a period of time. Therefore, as you accumulate each user, each user's accumulation of AUM takes time, and the revenue it generates takes time.
Mridul, I think one of the things we were thinking about is we've raised nearly 500 crores in our journey so far, right? And that seems a heavy upfront investment that is happening. How did you think about the fact that this is only a small check going in, but this business will need a lot more capital?
I did long back, I did an analysis of all these AMCs and wealth management shops and guess the capital employed in HDFC AMC. It's negative capital because they've taken whatever the bank put in has taken out. Of course, they had the distribution, the brand. So, you know what Vikram said, like these businesses are compounders. And what Abhinav said, they are maybe slow compounders. But honestly, like personally, I love slow compounding businesses because they give you enough time to make mistakes, learn from them, but also the accumulative nature of the business ensures that you have recurring revenues from the customers you acquire. So I still continue to believe that a business like ours should be capital efficient as compared to a lot of other consumer tech, fintech businesses, especially financial services, customer acquisition, especially if you want to do tech-led acquisition, is fairly expensive. And to me, the math should work out like what we're discussing in board meeting, right? Like as long as your upfront investment is justified by the LTV for customer, I think the embedded value in the business keeps increasing, right? So
I think just to add to one more point, see, you can have a bootstrap company. I mean, the thing is, it takes like 25, 30 years to do that. And we are living in a day and age where you may not have 25, 30 years to do that because there are competition who may be better capitalized and may capture your opportunity. So if you started in the 70s and 80s, maybe you could just like sort of bide your time and sort of take 30 years to become large. We're just trying to compact that to 10 years. The 30 becomes 10, and therefore you need upfront capital investment to pony up all the cost.
The only thing I would say just on this thing on the second and third and the tech investment and regulatory and compliance, I think in the first wave of fintechs, I would say most fintechs overbuilt tech and under indexed on financial services, and therefore there were a lot more hits, more misses than hits. And I think it is important to say what is the right tech at every stage of the business that you're in. And I remember in the beginning you said we are actually going to go after enough AUM that gives us this early base, and then the business will build from there.
I want to pivot to this whole question around how wealth management in India is evolving. We referred to some bit of it. Our thesis is that in the next 4 or 5 years, there'll be 1 crore crore-patis in India, right? And because there'll be 30 lakh households with more than 1 crore of financial assets. In some households, there'll be more than a few individuals there, right? How do you think the shape of the industry will change over the course of the next few years?
I think one part of it is that overall wealth as an industry is very nascent. You don't have, I mean, you know this better. I would say it's a less than the top 0.5% who really have access to true wealth products where you're accumulating assets, reallocating between those assets to time the market, and then compounding on those asset allocation over a period of time.
And that is reflected in the share of wallet that organized wealth managers have in India.
Yeah,
right?
exactly.
It is minuscule. Yeah.
So that's where wealth is. So I think the first thing is that as the country's wealth grows, I think we will see true wealth products, which is essentially people who are being trusted with assets, and then they're compounding those assets across multiple assets over a period of time. Today, that asset allocation is very bipolar between equity, pure equity, and essentially FTs, right? That's it. I think there's going to be a large manufacturing boom where you actually need the right products as this wealth grows so that this asset allocation is possible. So it could be coming from the securitization marketplace where actually India needs debt to grow, and we actually need to create those debt products so that the wealth can invest in that, right? Both corporate treasury as well as retail treasury, because the discovery of fixed income is just very, very low in this country. So there's a big market creation that can happen there. There's a huge market creation that can come on the digitization of sort of real world assets, whether it's gold, whether it's real estate. There's just so much that can happen in that realm. So I think there's one big trend line, which is just the manufacture of those and so on.
Yeah, see, I always think of this any model in fintech in dimensions of access, experience, and efficiency. I think one of the axes on which a lot of wealth tech startups, wealth management startups can think about is how do you increase access to the right kind of products. That access could even start with something as basic as saying, look, please think of portfolio allocation rather than only individual securities. but within that have a decent mix, and then we'll give you access. Anyone who's building today for next 5-10 years should really think about how do you enhance the experience. And fundamentally, I still believe India will remain a very expensive market to acquire customers. And while ARPUs will scale up over time, the business models anyone builds has to be built on tech with the thesis that that upfront investment will lead to efficiency coming in. So if founders, I like to think when I evaluate startups, or I would like to think anyone who's creating a business model to think around these three vectors. But this is going to be like a massive market where if you can solve for customers on access and experience, I think it'll be massive.
One of the interesting things you mentioned was that at different stages of different stages of the company, investors are different, right? But now all of you are on the board. The company is evolving, right? And you've sat on boards of companies from very early stage to taking them IPO, right? Do you also have to evolve? Like Abhinav, when you've sat on boards of companies which have scaled dramatically, does the kind of work that you do with the company also change?
I think it changes quite a bit. It changes quite a bit. Early stages, you're almost like a founding team member. Because early stage, when you've been a founder, nobody wants to buy a product, nobody wants to join your team, no investor wants to touch you, right? Like, so basically nobody wants to be with you. So it's almost like being shoulder to shoulder with the founder, especially if you're doing like the seed stages or seed. And at Series A's, you're sort of almost recruiting, selling, hiring, making investor introductions for the next follow-on round, receiving phone calls from customers who have had bad experiences and so on. So you're sort of almost part of that team. As the company matures, there is more focus on governance and compliance and ensuring that we are following a certain way things should be done for a large public sort of a company, right? So you transform from being maybe almost like a hands-on parent to being a grandparent.
That's a good analogy. If I'm a founder watching this and I had to build a checklist of the areas of what does governance really mean? Like what are the 4 things I need to ensure that I need to have in check, or 5 things I need to have in check? How would you put that? Like maybe
The biggest thing I tell everyone, and we've all seen multiple waves of fintech and everyone's been built with the right intent, is to say stop interpreting what the regulation says. It is black and white. Stop doing gray interpretations and those hacks. So it's quite black and white. And one of the most early hires, I'm insisting on a lot of fintech financial services companies to make you get a compliance head. Just comply, build a network of advisors or people around you within the firm who would show you, if you don't have that exposure, that what it means.
And I would go further than what Mridul is saying is stop interpreting, but you also know what the intent is. So you're saying, okay, this is the guideline, and therefore I'll just do the guideline, but I will actually do something else with respect to intent, and that doesn't work. You get your hand caught in the cookie jar at some point in time. And if your intent is to do something innovative, which is not in the guideline, go speak with the regulator. And I know you do that quite often, very openly. And our best founders actually go speak to the regulator saying, hey, listen, what we are doing is not exactly covered. And therefore, this is what we are going to do, and this is what we are proposing. And you put it down in writing. And that actually the regulator appreciates, right? Because then, it's in your file. And even if you go out and do it, then they know that, hey, you've said this in your file. We want you to make these tweaks. But if you get your hand caught in the cookie jar, then you're essentially gone sideways for 2 years. So I think one is this regulatory thing. The second part of governance is actually just a level of transparency with the people that are working with you and partners across the table. And one of the reasons that the shareholders agreement and all this takes so much time is that there is an asymmetry of information on what you know, because you're running the company day to day, versus what investors know. And founders who understand that and then actually are figuring out what is that level of transparency. You don't want that level of detail that you're seeing on a weekly basis, but transparent enough for us to actually make decisions. And I think that carries on into public markets.
when you all were talking about the fact that there is a Bombay DNA, which is financial services, things compliance first or regulations first. The flip side of that is folks like me have struggled with figuring out how this technology ecosystem actually works, right? Which is how do I acquire a customer digitally? Like that's not native to us, right? We don't get it intuitively, right? Or for that matter, how will a great user experience help business? That's really the hard part. So when you've interacted with founders from the Bombay DNA, how have you assessed for that or tried to complement that? I mean, maybe you can.
Yeah, I think, see, there is some level of consensus view that there is some financial services experience required to build a financial services company, whether it's insurance, whether it's wealth, whether it's lending, whatever. So there is that. At least in this scope, there's also this consensus view that tech and product are acquired skills. So we as investors or we as team together can help build that.
I want to move to the final part of the discussion. Again, it's been rumored that VCs get paid really well. And it'll be great to know how you personally invest. Maybe I'll start with Saravanan.
I'm a little lazy investor, right? So I see that pattern in the Indian folks, right? So they're a little more workaholic, right? So try to do a lot more on their work. I'm an investor myself, do that job full time. But when it comes to shifting gears to my personal investment, I've been like super lazy, right? So
after analyzing investments through the week, you don't want to look at it on the weekend. One more data point.
Exactly, right? So I'll get like, okay, I've done enough. Like, I try to outsource it to my wife. I try to outsource it to a person who kind of like I know and trust. It's a safe investment, right investment, bad investment. After talking to Sandeep, I got like swept away and planning to move my chunky size of asset management.
I thought you already had. If that's not chunky, then there is more coming. I'm very happy.
When it goes back personally, I kind of like end up taking a little more safer bet. Like let me take real estate, let me take gold, because the wiring, right? It just goes back 25 years on what is been told to you.
Vikram, how do you go about it? Because I know that all of y'all have a large exposure to your own funds.
So I was going to start there. I think like 95% of overall net worth is illiquid, and it's in my firm. And because we are significant investors, and then as your holding in the various companies through carry accumulates, it takes a long time to actually turn liquid. So on the other side, with the liquidity that you have, I tend to be very focused on very liquid assets to offset that, and with a mix of both equity and debt. And that's where the serious investing is. I do manage a small public portfolio actively, and it's really small compared to everything else. But it forces you to be making those risk reward decisions, and actually that constant touch with the public markets, I think, helps you be a better advisor to early stage companies. But a lot of that risk reward is to become a better investor, which then helps you in your core business. The only other thing I would say is that recently we now have a financial meeting between me and my wife to track so that we know what is happening. And in that meeting, we realized that the passive investing that we have done, which is identifying managers and just giving it to them on a weekly, monthly, quarterly basis, has made us more money than any of the active decisions that we have tried to time.
Well, I know like once wealth starts growing very rapidly, it becomes very hard to track it. Also, I know that is one of the challenges that all of you all have faced.
Tracking is a challenge. Wealth has not grown.
I think it's all relative. But
from an active investor standpoint, I think he's the most active investor. Every time, he always knows where the game is. So.
Now I do very little of that incrementally. I love reading stocks and doing direct equity. So again, as Vikram, I hope 95% of my wealth is in the future money that fund will make. But of the rest that I have, actually, I don't understand real estate. I don't understand debt. So 95% is equity. So incrementally, it's going to managers, of course, Dezerv being one. And but I still have an old portfolio which carries just one weekend a month. I would like to study. But basic stuff like it's one of those little book of value investing. Padke what you do, us type ka hai. It's not anything esoteric.
Very quickly, I'll keep it short. So very similar to all of them. A lot of my wealth is in Accel, and whatever is the rest of it is managed by advisors both in India and outside. And so it's very little to do with me. I'm just sort of picking up the right people to do the right things.
I hope for our sake that your funds do really well, because then we'll have more money to manage. Thank you everyone for doing this. It was a very special event for us. And it's been so much fun learning from you guys while building this friendship, partnership. So thank you so much.
Thank you.
Thanks for having us.